Hello everyone, I hope you guys are doing well and your studies are going in full swing. Now after the May 2026 AFM paper, there has been a lot of uncertainty in the student community in terms of how will you prepare for the additional questions, what are the additional concepts, how will we compile that. For that, what we have tried to do is we have tried to go through the entire material of the institute on the theory side and try to pick out areas where there are no practical questions in the study material or in the RTPs or MTPs on which probably institute may formulate a question. Now, based on that, we have curated a list of around 57 questions on a series of concepts like a lot of technical analysis, maybe certain detailed workings pertaining to the enterprise value, swaptions, exotic derivatives, a lot of these topic areas where there may not be questions in the traditional sense. However, with the current trend, there may be questions which can come. So there is this supplementary question set which we have prepared, which we have shared on our Telegram channel, the link for which is in the description, and it will also be uploaded in your Google Drive. Also, as an add-on, this is just for your additional reference, we have also prepared this kind of a small compiler which has additional theory topics from the institute study material. We will also share this on our Telegram channel, and over here what we try to do is we try to use a few of these additional theory topics. Like we have this compiler which will be there along with your shield, and also we have shared it on our Telegram where we have compiled all the theory questions, but there may be certain areas on which there may not be enough theory questions which are asked, and maybe some of which may be used for the purpose of practical questions as well. So what we have done is we have compiled this and made a PDF file, and in that we have also given the referencing of the page in the institute study material. So if you want to refer the same from the institute study material, you know the exact page from which it is. Like for example, certain charting techniques which may be there in your technical analysis, etc. So we have tried to compile that. Now, before you start this, I would kind of always assume and want that you do your core preparation properly. Remember, this is a supplementary add-on material which you should do in order to complete your holistic preparation, but this is by no means a replacement or a summary of whatever is there in your material. That continues to remain, that is continued to be your core preparation set, and this is an additional thing that will cover, let's say, the additional areas. Now the institute can formulate an AI based question on any of this, and it is not necessary that this exact same question will repeat, to be honest. However, remember, you need to have a boundary, you need to kind of understand that these are the concepts, this is the universe that you have, and within that the institute will generally ask you questions pertaining to that. So if you even cover this in addition to what you have already done, I would say that you are in a very good position to kind of attempt your paper. Okay, so with that we'll get started. So over here, in the initial part, let us say we will cover security analysis, security valuation, and mergers. That is covering around 20 odd questions and topics. This is going to be a mix of numerical questions, a few MCQs were required, a few case studies where possible, and we have tried to make it as close as possible to the institute exam questions that can come. So over here, the first part over here is pertaining to security analysis and valuation, where there is some discussion pertaining to technical analysis. Now, technical analysis has not been extensively tested in your CA final exams. Yes, there have been a few questions like exponential, moving average, etc. that we have done, which have also come. But there are a few other technical analysis terms which are there in your study material, for which we can possibly try to understand and try to go through the question set as well. Now, before we go to the question set over here, we'll also parallelly read the theory. Now, what do you mean by technical analysis? Technical analysis usually looks at the price trends, volumes, tries to develop patterns, and based on that tries to kind of come to buying or selling decisions. So you try to identify the trend looking at, let's say, the past price movements and the past volume of, let us say, the share that you are evaluating, and then decide whether there is a bearish or a bullish move and whether you want to buy or sell. So over here we are going to review a few charting techniques, a few pattern recognition possibilities, a few technical levels, and this can possibly help you in your overall preparation. So first, let us look at these charting techniques. Now, when you are trying to prepare the data, we want to find the prices, there can be patterns. So it is much more easily seen in a graphical form. So what are the various charting techniques? There's a line chart. Now what does a line chart do? It is a chart of the closing prices. Listen, the closing prices of each day. So successive closing prices. This does not have the high price, the low price, the average price, opening price. No, it is kind of a chart of successive days closing prices. This is a line chart. Now, as an improvisation over this chart, there is something called as a bar chart. Now, what happens in case of a bar chart is a bar is prepared. In that bar, there will be the low price, which is the bottom of the bar, and the high price during the day, which is at the top of the bar. So this is the low price, this is the high price. However, you also want to see the opening and the closing prices. So on the left hand side, an opening price will be kind of given, and on this right hand side, the closing price is given. So each day's performance is not really connected in the form of a line. However, it is given in the form of a bar. Like for example, if I look at 1st of January, your opening price is 58. So this level is around 58. Your closing price around 68. So this level is around 68. And then there is a high price of 72, which is the highest price, and the low price of 52, which is kind of the lowest price. So over here, there's no separate color coding that you will see in other charts over here, but you have 4 representations of a daily movement, the opening and the closing, which is given up over here. Like it is, see over here, the opening was lower, the closing was higher. It can also be the other way around. Like for example, the opening is higher, the closing is lower. So you can see the opening is above, the closing is below. This will be the lower price, this will be the higher price, and so on. So this is the form of a bar chart. So this is given in the form of vertical line or a bar, as the case may be. Now the third one on which MCQs can be possibly asked, or maybe a small true or false or a case can be prepared, is something called as a Japanese candlestick. So over here, when you look at a candle, it is not just a single line. It is going to be like a candle, something like this. So it's a Japanese candlestick. Now what does the candle represent? Well, the bottom of the candle represents, unlike a bar chart, like a bar chart, I would say, the low price. The top of the candle represents the high price. Now, along with that, I need to see the opening prices and the closing prices as well. So when I look at, let us say, this candlestick, just a second, over here, if I were to prepare the same in the form of a candlestick, this will be 58. At 58 will be the bottom of your candle, or rather the bottom of the line. At 72 will be the top over here. But let's say the closing price is 68. So this is 68 where your candle starts, and your opening price is 58. So opening price is around 58. Just a second. The low price is 52. So this is 52. The candle will be prepared between 68 to 58. So this is, let us say, your overall candle. Now, when I prepare this, instead of just showing these 2 small lines on the left and on the right hand side, I will prepare this, let's say, as a candle. Now, I want to color code this as well. Like over here, the opening is lower, the closing is higher. So this will be kept as a white candle. On the other hand, when I look at day 2, your opening is 71, your high is 73, low is 58. So over here on day 2, this is day 1. So on day 2, maybe you will have around your bottom at around 58. Then your opening price is 71, closing price is 64.3. So over here, this is 64.3, and this continues till around 71, but the high price is around 73. So your candle will be prepared. So we'll say, what is the big deal? You're just making a box. No, the color coding of the box is important over here, because the closing price is less than the opening price. This will be a black color candle. So when we look at the color of the candle, and this is a classic MCQ which can be prepared on this, the color of the candle can possibly show whether the price, the opening price, the relationship between the opening and the closing prices. So over here, if you look at, let us say, the Japanese candlestick, so but what if the opening and closing prices are the same, or they are almost similar? So if they opening and the closing prices are almost similar. Like if I look at 6th of January, your opening and closing prices are the same. In which case, what comes is there will be no candle. This is called as a doji, D-O-J-I. This is called as a doji, maybe a Japanese term, candlestick, where you will show over here maybe 76, which is a high price, 55, which is a low price, and your closing and opening price both are approximately at 74.5. So rather than making a candle over here, it will be shown, let us say, as a doji. So over here, maybe when I look at the Japanese candlestick over here, when I see the white candlestick, I mean the closing would be greater than the opening, which means this shows a bullish move on the particular day. Whereas a black candlestick will represent that your closing is less than the opening, which will represent a bearish move on this particular date. Whereas on this single day, this is a doji candlestick, in which case this will represent, let us say, a flat move on a particular date. So this is an important topic area for which MCQs can be formulated. Like over here, we are seeing black candlestick indicates closing price is lower than the opening price, whereas a white candlestick indicates the opposite, that is the closing price will be higher than the opening price. Another possibility of no change in opening and closing or very near is a doji candlestick. So on this, a possible MCQ can be formulated. This is also one of the charting technique. Next, you have the point and figure chart. When I look at the point and figure chart, this is one of the important techniques to kind of figure out a possible trend reversal. So if there's a trend or if there's a reversal, this is an important area. Like over here, you prepare this kind of a matrix, and in that you will put x's and zeros. So x represents the price going up consistently till the point it reaches a peak, and then when the trend reverses, you put zeros till the time it consistently keep on going down, till again you will start putting x's till the time the price goes up. Like for example, you start at 24, the price is going up, the price is going up, and then it starts going down. So from 24, which is the starting, you put x's till the time it touches 27, then it falls. Well, it just falls to 26 and then it again reverses, the trend reverses. So over here, this is 0 and 0 till the time it touches 26, then it goes up to 28, again goes down to 27, 26, 25. So over here, the zeros keep on going down, then from 25 again to 26, and then from 26 again down to 23. So over here, this is a very important technique if it comes in an MCQ for the purpose of predicting a trend or a trend reversal as a case maybe. So these are more complex than line or bar. They are used to detect reversals or trends or trend reversal in a particular working. So you will have to define, let's say we have said that the price change of 1 unit, 1 rupee, it can be 50 paise also, it can be 2 rupees also, but for simplicity you can take 1 rupee. Now, are we going to be asked to draw or plot these? In my opinion, no, but maybe you can be given a figure and you can be asked to interpret. You can be given, let us say, certain MCQs and you may be asked based on that. So that is something that you need to review. Now this is regarding various, let us say, charting techniques. Now, before we go to the questions, a couple of other things that we want to touch upon over here. First is something called as a support and the resistance level. Now, on this, a proper detailed numerical can be formulated, and that is also given in your material. So first, we'll try to review, let us say, certain theory for support and resistance level, and again, then go to the numericals. These are very important technical levels, and as the name goes, a support level refers to a bottom level at which, let's say, there is going to be buying pressure and hence the price is going to go up. So it acts as a support and the price will go up. Whereas a resistance level is like a top level where it goes up and it acts as a resistance for the price to break and does not go above that. So a support level is typically, in terms of a technical price pattern, it is kind of a bottom level at which we are expecting buying pressure to come in and the price to be lifted back again. Whereas a resistance level is supposed to be like a top level. So usually the peak of a previous price move acts as a resistance and the base of a previous fall acts as a support. Now, Remember, these are levels that have to be checked using experience and using your accepted let's say technical analysis. You will not just, I mean, in general, as a layman, you would say that whichever is the lowest possible price, that is my support, and whichever is the highest possible price, that is my resistance. Usually that may not necessarily always be the case. Your level is usually given in a range, like maybe 125 to 130 is like the base support and 145 to 150 is like the resistance. It need not be an exact point number. It can be given as a point number, it can be given, let us say, as a let us say range as well. But the idea over here is to ensure that you see a pattern, that when you can see that the price is falling, it acts as a support, again it goes up, again it falls, it acts as a support, again it goes up from that level. That kind of multiple times it shows that this is acting as a good support level. Now if that support is broken, we believe that that means a market has entered into a new range. So if, let's say, there's a support which gets broken conclusively with volumes, then the market is entering into a new, let us say, range, and that is a bearish trend, because support is at the bottom. If that gets broken, the price will fall further and your previous support becomes in a way the new resistance, because now the market will form a new bottom and the old support becomes a resistance. On the opposite side, in terms of resistance, what happens is, when, let's say, the prices are going up, uh, and let's say the resistance is broken, then you are entering into a bullish phase. Your prices are likely to go up, and if they're likely to go up, and if they're broken up in the resistance is broken up with volume, then we will say that indicates a new bullish move to be taken. And if they are broken, the resistance, which was earlier the case, becomes the new support of the new chart. Now we'll have to do this with a number set which will help you to understand this better. But if I just review, when the index goes down from a peak, the peak becomes a resistance, so the top is a resistance. Whereas if it rebounds from reaching a bottom or a trough, then the lowest value becomes a support level. Okay, the price is expected to move between these two levels. However, if eventually it will break these levels, which side we'll have to see with volumes. Whenever the price approaches a resistance level, there will be selling pressure. Why? Because people, in your language, would have FOMO. They would have missed out selling when at the high earlier peak. So that will be playing on their minds. And hence now when the share is reaching that peak, they will want to encash and want to book their profits. There will be selling pressure, because investors who fail to sell at the high would be keen to liquidate. While whenever the price approaches a support level, there's buying pressure, because investors who fail to buy at the lowest price would purchase the share. A breach of these levels, again with sufficient volumes, indicates a distinct departure from status quo. That is, newer levels will be set. And for that, let us say they've given you a particular question, a numerical set. It is not as clear over here because there is a lot of prices which are given. But if I were to look at, you can review these numericals from the institute material only. There's no formula for support or resistance per se. If I look at A, for example, when I look at A, well, over here you can see there is a lot of, below this level the price is not really falling. So over here, maybe close to around 100, I can say, is the support level. And over here, if I go to see, usually maybe uh, around 120 or above, maybe 125, 130, maybe is around the resistance level. You can kind of see that, maybe. And beyond that, maybe the market is setting a new level. That is also a possibility that can be taken. So there will be a few price patterns as well. But before you go to that, maybe we will do a few questions so that you understand, like question number 4, which is on support and resistance level. Let us say we go to the page number 3 where there's question number 4. So this is a relatively more cleaner way in which you can find a support or resistance level. One of that is also there, which we discussed. So following are the prices of ABC over 18 trading sessions. So when you look at this, you will see that, okay, 120, the price goes to 126, 138, 145, 140. So there are multiple prices, okay. However, the top over here seems to be 145. Then again, if you go to see the top, it reaches 145. Again, it falls. So you can see that this 145 is acting as a good resistance. Why? Because from 120, the share is went up. to a peak of 145, then it started falling, then it again reached up to a peak of 145 and it again started falling. So this can be a good point to say that 145, which is the top price over here, can represent a fairly good resistance. But when I look at the support over here, the price falls, it comes to around 126, again rises, falls, comes to around 129, again it rises. So maybe not exactly, but maybe around 126 to 129 will be a good support level. So over here I'm again saying that these will not be necessarily quoted as a single number, they can even be quoted as a range. So what is the approximate resistance level? We can say around 145 can act as a good resistance level, whereas what is a good support level over here? Maybe around 126 to 129. 126, then it is touching to 129 and rebound, so maybe around 128 or something can be taken as a good support level as well. There's no set formula. A technical analyst will use his judgment and based on that come to an appropriate level. Now we also want to do pattern recognition. So explain briefly why these levels are considered to be support and resistance. Well, because over here at 145 selling pressure repeatedly emerges and price fails to move higher, and at around 129 buying pressure emerges and the price rebounds. So it's like the support level. Now if on day 19, this is after the data series, the share closes at 149, so it has broken the resistance. So at the top it has broken the resistance with exceptionally high trading volumes. What is the likely implication? So over here you are breaking the resistance at exceptionally high volume. So we can say the market is entering into a new pattern, or in a new let us say the status quo is changing, and in the new pattern the new support would become, let us say, around 145. Similarly, if on day 19 the share closes at 123, what is the likely implication? Which means it has broken up the support and again a new pattern is formed where a new resistance will be created, let us say at around 126, 129, etc. So over here if I review, the price is broken above the resistance level, so that shows a bullish move. So this is a bullish breakout, so you're breaking out from status quo and let's say a new pattern is arising. The old resistance is expected to become the new support. This is what you should remember. And at day 19, when the price touches 123, it has broken below the support, in which case a new pattern, that is a bearish pattern, because the breakout, it is a breakout, you are breaking out of status quo, but the breakout is, for example, on the bearish side. So there's a bearish breakdown and the old support of 129 is expected to become the new resistance at this particular level. So we have even given a small explanatory note that while picking up in practice the support or resistance level, it is not merely picking up the lowest or the highest price. Like 145 may be the highest price, but it gets repeatedly tested, because at 145 it reaches, then falls, reaches, then falls. That is like the resistance. And maybe the lowest price over here is 120, but that does not automatically become, let's say, that does not automatically become a resistance level, because usually you see the price goes up to 126, 127, 129 and then it comes back. So you should be look for a price level where the market repeatedly reverses upward, that is the support, and this should be usually looked at twice for it to be considered meaningful. So this is pertaining to, let us say, question number 4 pertaining to support and resistance level. I hope if such a question on some concept similar to this comes, you should be able to solve. Now, if I look at a few MCQs for, let's say, the charting technique that we have studied. So question number 6, we have tried to form a technical analysis considering different methods of presenting stock price information. So this is for presentation. Okay, the analyst joins only the daily closing prices to identify the trend over time. This is called as a line chart. The analyst wants to display the open, the high, low and close prices, open, high, low and close prices for each trading day using vertical bars. Okay, they are not color coding it. It is just open, high, low, close. So this is a bar chart. The analyst wants to identify trend reversals, and by ignoring insignificant price movements and recording only meaningful changes using X's and zeros. Now these X's and zeros are a point and figure chart, and the analyst wants to show OHLC. OHLC is the opening, high, low and close visually, so that the color of the body immediately indicates whether the market closed above or below. Like if it closed above, then the color will be white. If it closed below, the color will be black. Identify, sir, this is a Japanese candlestick. So over here, these are, let's say, the techniques which you may be asked to identify. An institute has asked you certain questions like this, where they may have asked you to check patterns, not especially these, but they can formulate or they can ask questions similar to this particular point as well. Okay, so on similar lines, you will have question number 7, which is an MCQ set. Select below considering the charting techniques. So there's a Japanese candlestick has an opening price of 150, closing price of 162. So the closing price is higher than the opening. High is 170, low is 145. The candlestick indicates, well, the closing is higher and hence it indicates a bullish move. And if they are asking you the color, this will typically be a white colored candlestick. So let us see what they are asking. The candlestick indicates, I would say, a bullish candle, and the answer is B. Second MCQ within this, a doji candlestick. A doji candlestick would mean the opening and closing are almost the same. Is formed when closing price is much higher? No. Is much lower? No. Opening and closing are almost equal. That is right. And it's not highest and lowest are almost equal. It is the opening and closing to be almost equal, and hence the answer is sub point C. Which chart is specifically designed to identify trend reversals? Well, for trend reversals, maybe the point and figure chart is the most important one. By ignoring insignificant price movement, I would say point and figure chart is most for the trend reversal. Point D. Which chart only uses closing prices? I would say the line chart. Point A is only using the closing prices. So this kind of gives you an understanding of, let us say, these charting techniques and support and resistance level. Next over here, there is also a concept of identifying, let us say, patterns. So interpreting of your price patterns is something that we need to study over here. This is something which can definitely come for an MCQ. This can come as a small, let's say, identify true or false type of a thing. So definitely do this properly, interpreting the price patterns. Okay, so when we look at these price patterns, essentially these are, let us say, charts which are made and they will indicate certain patterns, maybe a bullish pattern where you expect the price to go up and hence the signal might be a buy signal, or let's say a bearish pattern where you expect the price to go down and maybe the signal may be a sell signal, or let's say there can be some uncertainty as well where you expect, let's say, a certain period of waiting before you take an action. So figuring out the pattern, figuring out the direction in which it is moving, and let's say the recommendation over here should be a good pointer for you to remember. So first of all, the pattern is called as a channel pattern. So over here what happens is you are making a high, then you are making a low, then the next high is higher than the earlier high, the next low is also higher than the earlier low, and this is broadly uniform. So when you look at a channel, this is an upward channel. There can also be a downward channel where you are having a channel like this and there was a high, then you go to a low, then there is another high, then another low. So you can see that the movement is happening approximately uniformly. So one can say over here that in case of a channel pattern, if it's an upward channel, the high is greater than the earlier high and the low is going to be also greater than the earlier low, and this gap is largely uniform. So over here, this is an upward channel, and in a downward channel, one can say that the next low is going to be lower than the earlier low, and the next high is also going to be lower than the earlier high, and these changes are largely uniform. So if it is an upward channel, usually it shows a bullish trend and hence maybe indicating an buy possibility, whereas a downward channel indicates a bearish trend and hence indicating, let us say, a possible sell. So a series of uniformly changing tops and bottoms gives rise to a channel. A downward sloping channel would indicate declining prices, and upward sloping channel would imply a rising prices. That is fine. Now, when you look at the next pattern, this is called as a wedge. Now, in a wedge, what is happening is the high and the low, it keeps on getting narrower. Like in a channel, what is happening, for example, the next high is greater than the earlier high. In case of a wedge, the high is lower, the next high is lower than the earlier high. So let's say this is the earlier high, it is fall, then the next high is lower, but the next low is greater. So can you see this movement is happening in an opposite direction? The high is falling and the lows are rising. So maybe the price is narrowing down, the range is actually narrowing down, that is, it is kind of getting cornered, or let's say getting into a wedge is what we kind of say. So when we look at a wedge pattern, you see the high, the next high is lower, the next high is even lower, and the low, it is keeping on increasing. So that is a wedge pattern, and this is a period of, let's say, consolidation where the prices are going to possibly consolidate into a particular range. So a wedge is found when the tops and the bottoms change in the opposite direction. So these are moving in the opposite direction. That is, if the tops are decreasing, as you can see over here, and the bottoms are increasing, as you can see over here, this is called as a wedge pattern. This kind of shows a period of consolidation, not particularly a bullish or a bearish trend. Next, you look at, let us say, head and shoulders. Now, the pattern of head and shoulders is quite literally, as you can see, the pattern over here. This is your shoulder 1, this is your head, and this is your shoulder 2. This is exactly, so this is a shoulder, head and shoulder. What are we doing? So over here, this is your shoulder 2, and the line connecting these 2 points, this line is called as the neckline. So over here, when we are looking at the head and shoulder pattern, there can be 2 possible head and shoulder patterns. One is a normal head and shoulder where you have, let us say, the shoulder 1 head and the shoulder 2, and the inverted head and shoulder where you see again the shoulder 1, the head which is inverted, let us say if you are doing a somersault, and let us say this is shoulder 2. Now the pattern, the trend, when you look at a head and shoulder, is largely, I would say, this is more like a trend reversal chart where after the second shoulder, how the price moves from this direction is very crucial. So if the price over here falls, then this is a bearish trend usually, which happens in the normal head and shoulder, as against to an inverted head and shoulder where you can see that after the second shoulder the price is going to rise. So this indicates a possible bullish move. This is what you have to remember. So when we look at a head and shoulder pattern which is getting formed, at least as per technical analysis, we would say in a regular head and shoulder, after the second shoulder is kind of completed, after, let's say, you cross the neckline price and it kind of falls, it indicates a bearish move. Whereas if it's an inverted head and shoulder, after the second shoulder crosses over here, this is a bullish move. So when we look at head and shoulder, one needs to remember that there would be a large lump, this is for the head, and in the middle of 2 smaller humps which are called as the shoulder. This can be said, if it comes in an MCQ, as an important pattern for the purpose of reversal of a price trend. So if the price is moving and the reversal of a trend, so this is more of a reversal of trend pattern. The neckline, as we see, is the pattern formed by joining the points where the head and the shoulders meet. So by joining these 2 points, you can form the neckline. Joining these 2 points over here, you can form the neckline. And over here, the price movement after the formation of the second shoulder is crucial. This is what is crucial, and they say a drop in the price, if it is indicated, the drop is expected to be equal to the distance between the top of the head and the neckline. So how much drop? Well, from here to here, this is the extent of a possible drop that you are expecting from here. So head and shoulder top, this is the regular pattern, and it's expected that the price is likely to decline, so it's a sell signal. And inverse, as we said, inverse head and shoulder is a bullish pattern, and the price is expected to rise above the neckline, and this is a signal to purchase. So this is regarding the head and shoulder formation. Then you have this triangular or coil formation. This is a classic uncertainty in a triangle. This is similar to in a way a wedge formation, one can say, but where let's say you are kind of narrowing, the price movements are in a way narrowing, but what is going to happen after this? Well, that is represented by a period of uncertainty. So the triangular triangle or coil formation represents a pattern of uncertainty and it's difficult to predict which way the price will break out. So over here, the wait and watch is the appropriate strategy. So over here, I would say this is even similar to a wedge. Even in a wedge, we were unable to give a clear decision. We were saying that the price is consolidating before it will break out, but in which direction, we don't know. So over here, a triangle or a coil formation. So why is it a triangle? Well, something like this. You see the shape of the triangle. So this is like a triangle formation or a coil formation where the price is in a way narrowing down, but this is showing a period of uncertainty. And then is a flag and the pennants form. Over here, what happens is, let's say the price was actually moving up. This was an upward move. However, before it resumes an upward move, it is inside a particular range. So this is like the flag or the pennants form. Again, this is in a particular range before it continues its move. So if the original primary move was an upward move, you can see that after the flag and pennants formation is kind of breached, it will continue with the upward move and it's a buy side. If it's a downward move, sir, how is it a downward move? Well, if it is something like this, excuse my drawing, but if it is something like this and then again it is falling, so this is like forming the flag and pennants formation over here. Once it breaks this, it is likely to continue with its downward move. So over here, this signals a phase after which the previous price trend is likely to continue. So previous price trend in this chart was an upward price trend, and hence that is likely to in a way continue. So this is a flag and the pennants form. Okay, then you have this double top formation and a double bottom formation. This is a little counterintuitive. Over here, it is almost certain that you will make a mistake. So when you look at a double top, as you can see, this is peak 1, you reach a top, that is the first, then it goes down, again this goes up, this is the second, so this is a double top. Now, ideally, one can say that after the double top formation, it is going up and up. So no, the technical analysis over here says that it has reached a top. Again, it has reached another top, which means there is too much. The price has heated up and hence it is likely that the price will fall. Usually, after forming a double top, it is usually shown as a bearish signal. This is after this point. We see that this is a bearish signal, and after forming two tops back to back, usually technical analysis says that this is a sell signal. On the other hand, so usually this is counterintuitive, because if you see that there is a top and then another top, logically we would say that that will represent, let us say, a buying possibility. No, we say that usually a top is formed, then another top is formed. Now a lot of people would want to book their profits, and hence there would be a possibility of a sell. So that is more of a bearish signal. But when a double bottom, you form a bottom, then there's further selling pressure, you form another bottom. That analysis over here is there is likely to be emergence of, let's say, more buying, and hence this is said to be a bullish move and indicates, let us say, a buying signal. So over here, this double top forms a bearish development. Top forms a bearish and indicating the price to fall, so you will sell, whereas a bottom forms a bullish development and indicating that the price is likely to rise. Okay, then you have gap. Now, what is a gap? Well, the markets close at around 3:30 and they open at around 9:15, and it is not like accounts where the closing balance becomes the opening balance of the next day. The opening will be different, and the extent of that gap, like if it's a bullish market, the gap is even more. If it's a bearish market, the gap is bigger. So usually the gap between yesterday's closing and today's opening, the bigger the gap, the more stronger the trend is there. Now, internationally, a lot of exchanges like London Stock Exchange is now starting a 24-hour trading platform to kind of move out of that gap. But having said that, at least in India, till the time you give your exams, you don't have a 24-hour pattern. So there will be a gap. Gap is a difference between the opening price on a trading day and the closing price of the previous day. The wider the gap, the stronger the signal for continuation of the observed trend. So this is something that you can remember. So other than that, well, there are certain moving averages which are there. Like we have done sums on exponential moving average, so I'm not doing that again. But there's possibility that the question may ask you something regarding a simple moving average or an arithmetic moving average. Well, it is very easy. Like in an exponential moving average, you have this risk of how do I find, let's say, the exponent factor, etc. That is not the case over here. In this case, it's a simple moving average. Like for example, if I were to take a 5-day or a 3-day or a whatever X number of days moving average, I will take the number of days simply divided by, let's say if I want a 5-day moving average, divided by 5. Then when I go to the next day, I remove the first observation and I add the sixth observation. So from day 2 to 6, I take the 5 days, divide it by 5, find the simple moving average. Again, when I go to the next day, well, I take the period from day 3 to, let us say, day 7 for, let's say, these 5 days, divided by 5, find the moving average. Now, usually the daily price may be a little volatile, but the moving average is relatively a much more stable. And practically, if I go to see that usually a 200-day moving average is looked at, the line of the 200-day moving average shows a long-term price trend. The line for a maybe a shorter 60-day moving average shows an intermediate price trend, and a shorter 10-day price trend shows a very short-term trend. So when the moving average is going up, it usually shows a bullish move. A moving average which is going down usually shows a bearish move. But when we look at the N period moving average, N can be, let us say, 200 days, but obviously in your exam you will not have 200 days, so maybe as a proxy you can take a shorter period. So let's say this is 5 days, so you will take the price of the 5 earlier days divided by 5, and that will give you the moving average. As we said, the 200-day moving average helps you in identifying a long-term trend, 60-day moving average for an intermediate trend, and a 10-day moving average for a short-term trend. And you can use this data. I mean, they've done it in a slightly more complex way. This is not something that is needed. Ideally, for a 5-day moving average, you will take the total of these 5 days. Let's say it is 127 divided by 5, that will give you the answer. Then on the next day, you take the total of these 5 days divided by 5, and you will get the answer. What they have done is they have done a 2-center total. It is not required. For sure, you can do a normal working. So what they have done is they have done 127, then they have taken the next 226, that they have taken 128, the total of the two divided by, let's say, 10, and they've got the answer. Ideally, this is not the best way. The simpler way would be just to take these 5 days, 127 divided by 5, then for the next day 128 divided by 5, 128.5 divided by 5, and so on. So this will help you in figuring out, let's say, the moving average. We have also discussed regarding exponential moving average, and this is where you calculate an exponent, that is 2 upon n plus 1. This is something which has been asked extensively, and this is the only area which has been asked, and you would have definitely done sums on exponential moving average. If not, please do that. It is there in your material which you should be covering, and you find the moving average. Again, if the moving average line is going up, that shows a bullish trend. Usually when you look at signals, there are various ways in which you can generate a signal. One of the most common ways in which a buy signal is generated is if the moving average line is, let's say, almost flat or moving up, and the price line cuts it from below. Then I can say this is your actual price line, and this is, let's say, your moving average line. So in a rising moving average line, if the price is cutting from below, this indicates, let's say, a buy signal. Whereas if the moving average line is, let's say, going down and the price is cutting from above, this, among other things, will indicate a sell signal. So there are other ways in which also where signals get generated. This is one of the most common ways in which a signal can get generated. There are various ways. They have given you 3 different ways in which signals can be generated. You can review that for a deeper understanding. However, we are usually not going to be looking at too much of technical conclusions. This can help you in broadly understanding these price patterns. And if we do a few sums pertaining to that, let us say at the beginning, there is a question on similar lines, even where the institute can ask you to identify the pattern considering the given data. So if I look at question number 1, an analyst makes the following observation regarding different stocks. So let me just try to cover this up. Observation: what are we supposed to do? Identify the technical price pattern in each case. First, successive highs and lows both are rising uniformly, creating 2 parallel upward sloping boundaries. I would want you to pause and think on your own based on what we have studied. What pattern does this seem to be? A similar question has also come in the exam, so you have to be mindful of this. This seems to be an upward channel. Channel had this uniformly rising highs and uniformly rising lows as well. So this is upward, they're going up. Okay. these are rising. If they were falling, then it was a downward channel. Okay, point B, after a strong upward movement, the price moves sideways within a small downward sloping range before again continuing upward. So this is a strong upward movement, then the price moves sideways and then it again continues. This was a classic flag and pennants formation. Okay. Point C, they are not asking you whether you should buy, sell, bearish, bullish. We have tried that in other problems, but let us say in this we can use the data for the same. Three peaks are formed with the middle peak being the highest. The price subsequently breaks below the neckline. Well, this is head and shoulder top. So if these were bottoms, then this is head and shoulder inverted. This is head and shoulder top formation. If I look at the first three, upward channel, flag and pennant, head and shoulder top, the trading range narrows over time because highs are falling while lows are rising. The eventual breakdown of direction is uncertain. We can either call it as a wedge, or this can also be called as a triangle. I would say triangle slash coil formation is the best when the question gives you data that there is uncertainty, but this can also represent, let us say, a wedge formation as well. So this is triangle slash coil, or you can even call this as a wedge formation as well. Point E, the stock forms nearly two equal peaks separated by a moderate decline. So this is like a double top. There are peaks, not bottom. So this is almost two equal peaks. So this is like a double top formation. This will indicate eventually that the price might possibly fall. So this is a good question. I would definitely mark this as important and something that you should do from an exam perspective. Again, at the beginning, we have marked, let us say, questions in the A, B, and C category. You can also review those questions and pick up those. This is definitely within the A category of those questions. Okay, predict the market signal. So here we are going in a little deeper where we're trying to predict the signal, whether it's a bullish, bearish, buy, sell to the extent possible. There will be no questions on this which have come, but if it does come, you should be kind of aware. So an investor identifies the following technical patterns. For each pattern, take the likely market expectation and then indicate whether there's a buy, sell or a wait and watch signal. Upward channel, I would say this is a bullish move and I would say this is a buy signal. In simple words, inverse head and shoulder. Okay, when I look at head and shoulder, it goes something like this, and it is likely that after this neckline, the price will go up. So this is a bullish move and this will indicate a buy possibility. Double bottom, a double bottom over here would be, you will have a bottom, then again almost you will make a bottom. After this, the price is likely to go up. This will also show, sir, all of these are bullish moves only. Well, not necessary. Let us see. You have head and shoulders top. Now, when you look at head and shoulders top, earlier this was inverse head and shoulder. When you look at head and shoulders top, the price is likely to fall. So this is a bearish breakout or a bearish pattern, and this indicates a sell signal. Double top, exactly opposite of this. Like you go to see a double top, once you have formed two tops, then it appears that the price will fall. So it indicates a bearish move and you will possibly sell. A triangle before a breakout, but in which direction we don't know. So this is uncertain and hence this will be wait and watch. There is no signal which is generated for triangle, and there is a flag after a strong upward trend. So after an upward trend, you are now in a flag formation. However, if it's a flag, it will eventually go up. So this will be a bull and a buy. So over here, maybe they may use technical words like a breakout, etc. I would say that as long as you are able to say bullish, 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 bearish, bearish, uncertain, and continuation of previous trend. So यहाँ पे it was going up, buy, 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 sell, sell, wait, and then buy. Okay, so over here, this is kind of going into your question number 2. Next, you go to question number 3. A technical analyst tracks 6 companies. First, the stock has been making higher highs and higher lows for several months. The upper and lower trend lines remain almost parallel. So this is again a upward channel. These are just different ways. It's an upward channel. Identified the technical pattern. This is an upward channel. State whether it represents a continuation pattern, reversal pattern, or market uncertainty. This is a continuation pattern where you are having a bullish move. Implication for the investors, it is again more for practice. It's a bullish move where you will possibly buy. The stock witnessed a sharp rally. Rally means the price goes up, followed by a brief consolidation inside a narrow downward sloping trading range. Thereafter, price resumed their previous upward movement. So this is again a flag and a pennant's formation. It shows a bullish move, which will again be a buy signal. The stock reached a high, corrected, made an even higher peak, corrected again, and finally made a third peak, almost equal to the first. Now this is third peak. So this is a head and shoulder top. Prices then fell below the neckline. So this is head and shoulder top. Okay, the stock repeatedly forms lower highs and higher lows. Lower highs, higher lows. So it is going in a wedge, or let us say a triangle slash coil. If the question says uncertainty, we'll say triangle slash coil, causing volatility to contract progressively. The traders are unable to predict the eventual direction of the breakout. So we can either call it as a wedge formation or even a triangle slash coil formation as well. Stock falls sharply, rebounds again, declines to almost the same low, then again starts rising with increasing volume. I think this is a double bottom. So this is a double bottom, and this shows a buy slash bullish move. After a prolonged fall, the opening price of the next day is substantially below the previous day's closing price, leaving a visible gap on the price chart. This is like a gap, a downward gap, where it indicates a bearish signal, and thereby you will again want to sell. So when I look at the first, there is a channel, flag and pennant, head and shoulder top, triangle slash coil, double bottom and downward gap. This is sell, double bottom is buy, triangle is waiting for a breakout, head and shoulder top is bearish, flag or pennant is maybe buy, price likely to continue rising, again this is buy. So basically these are various points. Usually head and shoulder or the double top, double bottom are reversal strategies, whereas channel, flag and pennants, etc. are more continuation types of strategies. Okay, next you go to question number 4 is done. Now 5 is more of a moving average and a trading signal. The closing prices of equity shares of XYZ over the 5 consecutive trading days are as follows. So you have the 5 trading days over here. You are required to calculate a 3-day simple moving average. Well, if you can do it for 3 days, you can even do a 5-day, 10-day, 15-day moving average as well, based on the movement of the closing prices and the moving average. Comment briefly on the likely trading signal. So if I look at the 3 days over here, this is 100 plus 102 plus 104 divided by 3. So this comes to what? Probably 306 divided by 3, I think 102. Then when you go to the 4th day, I'll remove the first observation and I'll say 102 plus 104 plus 106 and divide this by 3. So this comes to probably what? 312 divided by 3 comes to, I think, 104. So this is rising. Then I remove the earlier observation. I have 104 plus 106 plus 108, divide this by 3. So this will be what? I think, let's say this is 106. I can see that the closing prices are going up. I can also see that the moving averages are going up, and hence this indicates a strong bullish move. And let us say a buy signal, though it's a very small moving average. It's a 3-day moving average. People actually take 200 days, 60 days, etc. But here, I mean, if you're made to do a 200-day moving average, half of your time will just go in taking the total on your calculator. So this is just helping you understand कि भाई, if there's a simple moving average question, what do I need to do? Because we have done exponential moving average. This is a simple moving average. It is rising. It indicates a bullish trend. Question 6, 7 we have done, and then we can even go to a few other technical analyst workings. Like for example, you can have a few market indicators. Now market indicators can include something like breadth index. Now breadth index is like the advances or declines. Like for example, if there are 2000 stocks which are listed on the BSE, I want to figure out how many were the actual advances. Let's say out of these 2000 stocks in a particular trading day, 1500. So this was, let's say, 75%. Let's say it is a bullish signal. It's a very strong bullish signal because 75% of the stocks are actually rising. It is not just at the Nifty 50. See, the problem is you always look at the benchmark like the Nifty 50, etc. However, that is a very narrow because Nifty 50 has only 50 stocks, Sensex has only 30 stocks, but the wider market we don't know. So the breadth index shows you how the wider market is moving, and if your rise is backed by a wider market move with good volumes, that indicates a strong bullish pattern. So the market rises by 2%, but only 20% of the listed shares advance. Now this is a little strange. Maybe a few of these heavyweight stocks have gone up a lot. So only 20% of the listed shares advance while the remaining shares decline. What does the breadth index indicate? Strong strength, no. Weak technical strength despite the index rise. Yes, I would say bullish, no inference. No, I would say there is weak technical strength because over here there is relatively lower strength because only 20% of the stocks have risen. Okay, next you have what? Next we have, let us say, uh, 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 the second MCQ. This is on volume. Remember, trading or technical analysis focuses a lot on volume, a lot on volume. Why? Because a price rise merely is not sufficient, but if it is along with volume, it indicates a much more stronger move. So stock increases continuously while trading volumes also keeps increasing. That indicates a strong rally, not weak. Strong buying interest, that is right. So this is answer is B. Now you have confidence index. Now confidence index is usually the ratio that you, so when I look at breadth index, this is the index which shows the proportion of advances to the declines in a similar advances to total or declines to total. This is your overall breadth index. Whereas when we look at, let us say, a relative strength index, when we look at confidence confidence index over here, we'll look at, let us say, the yields on high yield bonds and YTM on low yield bonds. Kind of the spread over here will help you in figuring out the confidence index. So if the confidence index, as the name goes, has been steadily rising, that indicates strong pattern. This indicates decline in prices, investor confidence is improving. Yes, that is correct. And a rising market may follow. So a stronger confidence index, and confidence index will look at the index considering the yields on high rated bonds and yields on the low rated bonds. So high rated bonds like a triple A rated bond and a low rated bond like a B, C type of a rated bond. Based on that, you are trying to build up confidence on the strength of the market movement. Okay, then you have relative strength, that is how much are you moving vis-a-vis. Like when you look at let's say like Nvidia moved up significantly relative to the US S&P 500. So we are trying to find your relative strength considering the volume. So you might be rising, but a lot of small cap stocks rise on very narrow volumes. We will look at the volumes, we will look at the price rise, and relative to that of, let's say, the market or your competitors, that is a relative strength. A stock rises 18% during a bull market while the market index rises only 9%. So you have stronger strength. This may be because you have a higher beta as well, but you have a stronger strength which is relative to that of the market. So over here, according to relative strength analysis, stock A demonstrates a relative strength. Of course it does, because it, as compared to the market, it is rising stronger. Again, these are small theory points which don't have any calculation formula, anything given, a small section. So maybe a brief explanation and maybe an interpretation through an MCQ is a good way to solve. Obviously, if you want to deep down a little more, you can always clip a snapshot of this and say, let's say, to an AI that probably formulate a small numerical question or explain me a little more about it, and that can work. Again, that is on you. But I would say that having a broad understanding that, well, what does breadth index look at? Well, it is advances to total. Or what does confidence index looks at? Well, it looks at, let us say, the yields on the high rated and the low rated bonds. Relative strength looks at your strength vis-a-vis the market. All of these can be kind of possibly looked at. When you look at the odd lot theory, on the other hand, just a second please. The odd lot theory says that the average investor like you and me is always wrong. So, and this is generally seen that when your stock market discussions start entering into your living room, when everyone in the market gets euphoric, everyone wants to buy, that is when you should sell. That is what they say. That the average, this is like a contrarian theory. Then when everyone wants to buy, that is a time where there's too much greed. That is when you exit, that is when you sell. And everyone is fearful, that is the time you buy. So when you look at the odd lot theory, this is like the contrarian theory. If small retail investors are aggressively buying, you exit, is what the thought over here. A contrarian investor, that means an investor who takes the contrary position would most likely buy immediately, sell or remain cautious, ignore the information, short the entire market. It's not as strong a signal that you sell everything. However, you will start selling or you will definitely remain cautious because there's too much. People who don't know, I mean, this is what happens in gambling when you kind of, someone who does not know the card game is still making money. Everyone is interested that, well, that is easy money, and hence everyone wants a share, and that is where the price fall is usually imminent. So over here you look at point B over here. Now there are three other theories which you have as the Dow Jones theory or the Elliott wave or the random walk theory, which is also, which was there in your theory. In fact, Elliott wave was a theory, it is there in the compiler, which also came in one of the theory questions, but we will just try to discuss that again a little and see the technical interpretations which can be implied using these three theories. Now, there are these three theories which are there in your material. It's there in the theory compiler as well. We'll do a quick recap and try to see if we can try to have a case to identify these. First, there is something called as the Dow theory. This was developed by Charles Dow, who was the founder of the Dow Jones Industrial Average Index, the Dow Jones that we see, and the Dow Jones Transportation Index, which are the two indices that he uses. Second is the Elliott wave theory, which is still very popular in technical analysis, and this was developed by Ralph Elliott, I think, and this was in the 1930s based on the data after the Dow theory. So Dow theory is a relatively older theory, after which the Elliott wave theory came in, and then there is a random walk theory. So if we quickly understand what each of these theories try to say. So the Dow theory says that your market movements can be broken down into three parts. First is a primary movement, which goes on from around 1 year to around 3 years. That is a primary, like the bull or the bear movement. Then there is, let us say, the secondary movement, which is usually in the opposite direction of the primary movement. So if the primary movement is an upward, that is a bull movement. The secondary movement is a relatively shorter movement going on from around 2 weeks to up to, let's say, 2 or 3 months, which is the opposite movement, which is like the correction movement. It is generally in the opposite direction. And the third is the daily movements, the daily day-to-day fluctuations. The Dow theory does not look at the daily fluctuations. They look at the three, out of the three movements. First is the primary movement. Second is the secondary movement. Secondary movement is generally opposite of the primary movement, and so these two are covered under the Dow theory. And the third is the daily fluctuations, which Charles Dow does not look at. So he looks at two indices. One is the Dow Jones Industrial Average and the Dow Jones Transportation Average. So when these two indices are largely moving in the same direction, they say that for a long sustained period of time with adequate volumes, that shows a particular trend. Now usually if the primary movement is upward, then the secondary movement, so this is between 1 to 3 years, whereas this is a downward. Remember, this is a fairly old theory. I mean, this was in the late 19th century. It is 1800 and something. So it is way too old a theory, but still it kind of works. So this is between 1 to 3 months, let us say, loosely speaking. And this will be usually the opposite of your primary movement. Now, if both of them, so if just one of these indices is moving, it does not show a strong move. But if both of them are moving with convincing volumes, then one can say that it indicates a fairly strong move. So this is regarding the Dow Jones theory, which looks at the primary as well as the secondary movement. Secondary movement is sometimes also called as a corrective movement. Now, when I look at the Elliott wave theory, it is a theory formulated by Ralph Elliott, as we said, looking at 75 years of stock data. And he divides the moves in the market into two parts. First is something called as impulsive, also called as motive, uh, let's say, waves. And second waves are something called as corrective waves. So the way this theory looks at, maybe it in the impulsive waves, well, you will have, let us say, waves which are first going up, then down, then again up, then down. Remember this, it is going in an upward direction. Okay, again this is going up. So this is wave 1, 2, 3, 4, 5. So this is your impulsive. For example, it's an upward movement, so it is an impulsive, let us say, move. And after this you have the downward moves. So for example, you fall, you rise, you fall further. So this is wave A, this is wave B, and this is wave C. This is called as the corrective moves. So the entire, let us say, cycle of 8 waves made up of 5 impulsive and let's say 3 corrective make up, let's say, the Elliott wave. In the Elliott wave, the first 5, in this case moving upward, it can also be moving downward, will show the primary or the main movement, which is largely upward, and the next 3 will show, like say, the corrective movement. Like in Dow Jones, you have the primary and secondary. Here you have the impulsive as well as corrective. Now, while you look at, let us say, the random walk theory discards both of these. In fact, it discards everything in technical analysis, and they literally say that in random walk theory, the prices move like a drunkard man. That is literally what they have said, where if you have a completely drunkard person, the I mean, if you predict that where will he put the next foot, well, he's just swaying around. You don't know where the next foot is going to fall. It is a completely random move, and hence they say that there is no point investing, or in a way wasting your time looking at past price trends or volumes, because the movements are random. Yes, there might sometimes be successive highs or successive lows, but that does not by any means, that does not by any ways showcase that there is a possibility. Like over here, even in Elliott wave or then the Dow theory, when the market is going up, one can say that you are making successively higher highs and then successively higher lows as well. Even over here, you can making successively higher highs, successively higher lows. So over here, random walk says that is pure chance, that is pure coincidence. It is not an outcome of any technical or a movement. It has happened randomly. And I mean, people in the 1970s or so even tested the performance of the 10 stocks picked up by 10 top fund managers with the stocks picked up literally from by a monkey. Now, how do you, as a monkey, they just gave, let us say, a pile of bananas, and next to every banana they wrote a name of a stock. The monkey picked up a few bananas, and you know what, the monkey stocks actually outperformed those of the fund managers. So the random walk tries to say that the markets or the prices move in a way randomly. You can't really put that into a pattern or a line, and hence they say that you cannot really make a profit by just looking at past prices, or let's say past volumes. So over here, price movements, I would say price movements are random. So over here, mostly if I expect a question on this, I would expect maybe a theory or answer in brief question on these points rather than a full-fledged descriptive one. But if it does come, we are just covering around 3 cases, which may come as a case study type of a approach. So let us review question number 9. A market analyst makes the following observations. The market has been making successively higher highs and higher lows over the last 18 months. So that's a fairly long period of time that indicates, like, say, the direction of the primary market. After every short term correction, the prices continue to move upward. So there is an opposite move, a secondary move, which is going downward, but after that the price is going up only. The transportation index has also started moving in the same direction as the industrial index. So over here, both of them moving together gives a much more stronger technical signal. What type of primary trend is indicated? First of all, this appears to be data regarding the Dow theory. It is not random, so it is not the random walk theory. Further, there is no clear wave pattern like it is there in Elliott wave. So this is like the Dow theory. In the primary market trend seems to be a bullish upward movement. Okay. Next, which movement of Dow theory is being observed over the 18-month? Well, it's a primary movement. Remember, if it is for, let's say, a few weeks or a month or two, that is like the secondary movement. But this 18-month observation is a longer term, more than a year observation, which showcases a primary movement. So the market is in the bull market trend and the movement is a primary movement. Why confirmation of both industrial and transportation is important? Because that shows a much more stronger technical trend. A market trend is considered to be reliable only when both, as per Charles Dow, these are the indexes which are formulated by Charles Dow only. If both of them are moving in the same direction, that showcases a stronger technical move. Okay, next is the Elliott wave. The technical analyst observes that the stock has completed a sequence of 5 upward waves. Okay, these are called as impulsive, or sometimes it is also called as motive waves. He predicts that the next movement will be 3 wave downward correction. So these are called as corrective waves. Now, this is indicative of an Elliott wave theory, which is still used by technical analysts, by the way. Again, in that, there's a lot more technical detailing, like that when I look at this fall, it cannot be uh, higher than the top of this peak. And there's a lot of things over here, which is not there in the material. But if you want to study a lot more, Elliott wave has a lot more, and it is applicable, and it is looked at by even today's technical analysts a lot, after which another long-term upward trend may begin. So this is a total 8-wave cycle, which is an Elliott wave cycle. You are required to identify the theory which is represented in the above. So this is the Elliott wave theory. Okay, which waves represent the impulsive pattern, waves 1 to 5, and which represent the corrective pattern, maybe the last 3 waves. We can call this as A, B, and C. Do you agree with the analyst's prediction? What is the analyst predicts? Another long-term upward trend. Yes, that's right. So the entire cycle gets done in around 8 waves, after which an upward trend can possibly begin. So over here, according to Elliott wave, a market cycle is consisting of 5 waves, which are impulsive, followed by 3 waves, and after which uh, the next impulsive cycle begins after this total set of 8 waves. Okay, there's a concept summary also given over here. Then there's a random walk theory case. An investment manager states that I do not believe in historical price charts can consistently predict stock prices. Every new piece of information is immediately reflected in the market prices, and therefore future prices are largely independent of the past price movements. Okay, so this is a manager who is believing the random walk theory and is not a proponent of great technical analysis required. You're required to identify the theory. This is a random walk theory. Would the investment manager rely heavily on technical analysis? Not at all, no. Because as per random walk theory, past price movements do not provide a reliable basis for future price, and hence you have to do a fundamental analysis, try to get insider information, etc. Is the way you can make profit, as per at least this theory. What implication does this theory have for investors attempt to earn abnormal returns using historical price data? Well, they will not be able to earn. The investors cannot consistently earn abnormal returns merely by analyzing historical price data, because movements are random and statistically independent. Okay, so these are the 3 theories. Apart from that, this is not really always a technical analyst working, but when we studied about efficient market hypothesis, if you have done, well, efficient market has that weak form, semi-strong form, strong form, etc. And to test whether the market is weak form efficient, there were 2 tests for which there are proper sums, and these are highly statistical questions. One is on serial correlation, if you are aware, that is autocorrelation. If or autocorrelation is a correlation with your own self. Like if there's a 20-day data, you split it into 2 subsets of 10 days each and see that whether the first 10 days and the next 10 days are correlated. Ideally, they should not be. That is when the price movements are random. However, if they are, that shows, let us say, autocorrelation, a correlation with your own self, and hence your weak form of efficient market hypothesis fails and your market is said to be inefficient. Second is something called as a runs test, and we have done detailed problem on the runs test as well as autocorrelation in your core material. So you don't, like, exponential moving average was an important thing. In a similar way, runs test as well as autocorrelation, when you look at the runs test, where you try to find the positive or the negative signs and you find the number of runs. If the number of runs are too many or they are too few, then we said that, let us say, the market is inefficient, not weak form efficient. However, if the number of runs are within the range of randomness, then we say that the market is in a way weak form efficient. So we are not doing that runs test or autocorrelation right now. However, there is also a third test which is given in your study material, which is called as a filters test. Now, what does a filters test say? It says that you might have a filter, like for example, if the stock price go up by, let us say, 5%, then you will buy. And then once you buy, you will keep on holding till the time stocks reaches a particular high, and then it starts falling till it falls by, let's say, 5% is when you sell. Now you are going to compare this with the traditional buy and hold strategy. See, this filters test is basically a test. It is a test over here that you are trying to have a set of rule. Like, what does autocorrelation do? I know that in the last 10 days, if the share has fallen, now it will rise, or something like that. So we are saying that if that does happen, you are looking at the past price movement and then predicting what will happen in the future. So the market is inefficient. However, if the last 10 days have no meaningful correlation with the next 10 days, we'll say that, well, you know what, the market seems to be efficient. In a similar way, if you can put up a test like this, like if the market if goes up by, let's say, 3%, that it can be any percent, n%, it goes up by 3%, then I will buy the stock. I will keep on holding till the time it goes up, even when it falls, till the time it falls by 3% or more from its peak, I will keep on holding. So that will be 3% is a filter, 5% is a filter. How do you calculate? Well, we don't know. Maybe if that filter's return consistently outperforms the return of a traditionally buy and hold, in sometimes by chance or coincidence it may, but if consistently outperforms the traditional buy and hold strategy, then we will say that over here there seems to be a market inefficiency. You are able to earn more, but usually it has been seen empirically that the filters test has generally not worked, which means the buy and hold strategies, especially after you consider the transaction cost, brokerage, etc., has outperformed the strategy of a filter, and hence filters test is not applicable generally. That is given in your study material, though we can try a numerical on this. Like for example, if I review a bit of a theory on the filters test over here, I don't know, yes, this is the filters rules test. This is for efficient market hypothesis. In your study material there is, I think if you see, this is on, I think, page number 4.32 or 33, where you will have autocorrelation, you will have, let us say, runs test, and then there is a filters test. If the price of a stock increases by at least n%, let's say 5%, we can take any number, buy and hold it until the price decreases by at least n%, that is another 5% from a subsequent high. When the price decreases at least n% or more, sell it. If the behavior of the stock price changes is random, filters rules should not apply in such that a buy and hold strategy. So I would say that in general, if the market is random, then applying such filters will not give you a return which is greater than a traditional buy and hold strategy. But if it does, then the market is inefficient. By and large, studies suggest that filter rules do not outperform a single buy and hold strategy after considering especially commission or transaction cost. So over here, if I were to review a numerical, let us say for a filters rule, the current market price of ABC is 500. A technical analyst follows a 5% filter rule. Subsequent price movements are as follows. It's a 5% filter rule, which means 500 into 5%, that is 25. So if the price moves at least 25, then you will buy, or if it falls at least 25, you will sell. So it moves to 525, so over here you will actually buy. Then over here you will keep on holding till the time there is a fall. So there is a fall, and this is 520. So over here 550 into 5% comes to what? Maybe 550 into 5% is 27.5, which means if it falls from 550 down, let's say, to 522.5 or below, then you will sell. If it falls to 520, basically you will sell. So over here, identify the buy and the sell signals. The buy signal will be generated at 525 and the sell signal will be generated at, for example, 522.5. Under the 5% filters rule, explain the objective of using such rules in technical analysis is that you don't really take a position till the time there's a meaningful move. So a buy signal is generated when the price increases by at least 5%, goes up to 525. After it is reached, then the highest observed price after that is 550, and the sell signal will be generated if the price decreases by at least 5% from that level. So that is 522.5. So if the price touches 520, a sell signal is generated. The objective of a filters rule is to eliminate insignificant price fluctuations and generate trading signals only when the prices move beyond a particular predetermined percentage. This is how filters test is applied. Sometimes you might have to check this for the application of efficient market, in which case what you will do is you'll compare the gains from a filters rule, multiple prices might be given, with a traditional buy and hold strategy, and consistently if the filters test, the returns under the filters test outperform the traditional buy and hold, then I would say that the market is inefficient. I can just put in filters and earn a return which is greater, uh, and hence your market is inefficient. Like uh, these are three tests, actually, two of which have problems, like autocorrelation and runs test. Filters test does not have a problem, but if it comes, they will give you a filter like this for 5%, and they will ask you to calculate the overall profit under this strategy and maybe compare this with a traditional buy and hold strategy to come to an appropriate conclusion. Perfect. So that takes care of the security analysis, one of the most extensive material, especially pertaining to technical analysis, for which a question can possibly come. Second, we'll go to security valuation. Over here, also, we are going to discuss a few concepts. Like one concept we have done a lot in all your numericals, which is on enterprise value. So maybe some more detailing on some things like minorities interest, or things like what will happen if there is a deemed debt provision like an asset restoration or a lease liability, core enterprise value, operating enterprise value. All of these are there in the study material, though your sums have a single enterprise value working. So we'll do one question on that. Then we'll look at various alternative ways to find free cash flows. To some extent, we might have done that, but again, we'll review a few things, like you can use EBIT and find free cash flow to the firm, PAT and find free cash flow to the firm, EBITDA and find free cash flow to the firm, cash flow from operations and find. So maybe different ways. In dividend discount models, like you have the H model, that is also something that we will want to discuss over here. Also in terms of bonds, maybe trying to study a bit more about the spot rates and the yield curves and certain yield curve theories is what we want to kind of cover in the security valuation section. So first of all, we'll go on into the enterprise value, and in the enterprise value section, there are a few things that we need to know. So over here, like when you look at enterprise value, this is an extract from your page number 5.14 of your institute study material only, from which a numerical can come. Now, typically we have done enough questions of enterprise value, I believe, where you say that enterprise value equals to the value of debt plus the value of equity, and if there is any cash, then you subtract the value of cash and cash equivalent from this overall value. So over here, now usually, I mean, people adjust the debt, so I can call this as value of equity plus the value of debt minus cash. So some people call it as net debt, that is fine. So this is your enterprise value calculation in general. However, you have not seen questions where there can be minority interest. Like for example, there is a Reliance Industries Limited and it has Reliance Jio, which is one of its subsidiaries, where Reliance owns 70%, but 30% over here actually is held by non-controlling interest or minorities interest, which is 30%. Now, if I look at Reliance share value, it will incorporate the value of the Reliance business as well as its 70% share in the Jio business. But the real size of Jio's business is not just 70% of the Reliance stake, it is the entire. And hence, even minorities interest need to be separately added. The value of the minorities interest needs to be separately added. This is not, there's no detailed numerical as per my understanding over here in the institute material, but it is there in your theory. So basically, this will also include minorities interest or non-controlling interest. Your equity value separately in the enterprise value, you will also add the minority interest value separately. Further, similar to debt, there may be deemed debt like liabilities. So debt like liabilities, like lease liabilities, like asset restoration or obligations. These are also obligations. These are also liabilities. So they will also be considered as a part of your enterprise value. This is your first thing. When you look at your total enterprise value, what will this include? Value of equity plus value of debt plus value of preference shares, if any. But it will also include minorities interest. It will also include debt like provisions, like asset restoration provisions or lease liabilities. The question will tell you that, minus cash, and this will give you your total enterprise value. However, the question might also ask you to calculate what is called as operating enterprise value. So if I review over here, there would be total enterprise value, which is value of equity, plus you will also add minorities interest, plus value of debt, plus you will also add debt like liabilities, like lease liabilities, asset restoration obligations, plus the value of preference shares, if any, and minus cash and cash equivalent. So this will be your total enterprise value. Now you want to find your operating enterprise value. So in operating enterprise value, you will deduct from your total enterprise value, you will deduct, let us say, the value of non-operating items. Like if you might have certain investments in affiliates, investments in associates, investment in general equity shares, you will remove that from your value. So total enterprise value will include, or total operating enterprise value will be minus value of, let us say, equity investments, which may be you might have done in affiliates, in associates, in normal equity shares, etc. So that is what they say. You will have to deduct this. And thirdly, they may have core enterprise value. Now in core enterprise value, you will take the operating enterprise value, and from this you will deduct the value of non-core, your non-core assets. So over here you might have, let us say, investment property or vacant land, which might be giving you a rental income, but that is not core. So non-core you'll have to identify. So let's say vacant land or investment property which is earning returns or yield, etc., you will remove. So you will, if nothing is given, we will take the enterprise value, which is a total enterprise value, which may also include certain new things. And additionally, there might be certain adjustments that might be needed. So if you review over here, enterprise value is the economic value of the company as a whole. You will add, as they say, market cap, long-term debt, minority interest. An important point, also minus items like equity investments in associates, affiliates, long-term investments, etc. So over here, there are a few things that we need to apply. So market cap, net debt, minorities, deemed debt provisions, other claims, sum of all of these values on the enterprise. And enterprise value can have core enterprise value or separate value for non-core assets. So as we said, enterprise value is of three types. See, you see over a total, operating, and core. Total is the value of all business activities. Okay, so this will include everything that we have discussed earlier. However, the operating enterprise value is the value of all operating activities, and to get this, we'll have to deduct the market value of non-operating assets, which includes investments and shares in associates from the total enterprise value. You will have to deduct this from your total value, and then you look at the core. Core enterprise value is the value which does not include value of operations which are not part of the core activities. To get this, we'll deduct the value of non-core assets from the operating value. Okay, so this is kind of a few nuances that can come when it comes to the enterprise value, and we have tried to formulate a numerical on this so that you can apply this and see. So this is question number 13. ABC is being evaluated by a private equity investor for a possible acquisition. The following information is available on 31st March. So you have all of this data which is given, and you have been told, so there is market cap, long-term interest-bearing debt, this is your debt, lease liabilities, which is debt-like obligation, provision for asset restoration, these are important things, which is also a deemed debt-like provision, minorities interest, these are new things. Then preference share, which we have done, cash, investment in listed equity shares, investment in associates, vacant land, investment property for earning rental income. These are more nuances when it comes to enterprise value. And you have core EBITDA. So you have been clarified that lease liability and restoration provisions are debt-like obligations, so they'll be a part of enterprise value. Investment in listed equity shares and associate companies are non-operating assets, so this will be removed for operating enterprise value. And vacant land and investment property are non-core assets. Great. Comparable listed companies in the same industry are currently trading at an average EV by EBITDA multiple of around 9.5 times. Okay, so you have been given core EBITDA, so maybe they are also having core EBITDA of similar companies. So what do we are supposed to do? Total enterprise value, operating enterprise value, core enterprise value, and then EV by EBITDA multiple of ABC based on core working. So we have clearly been told, compare the company's EV by EBITDA with the industry's average and comment on whether it is under, over, or fairly valued. That is fine. And two reasons why EV multiples are generally preferred over equity value multiples, because they, I mean, to be honest, the main reason is they look at the entire company and not just the equity share. So over here, if I look at the total enterprise value, this will be what? Well, I will start with 1800 plus 650 plus even 70 plus 40. All of these I will add. Even minorities of 90 I will add. Even preference share of 60 we will add, and cash and cash equivalent we will deduct. Now after this, all of the other items will impact operating or other values. So this is what 1800, 650, 70, 40, 90, 60 minus 180. I guess 2530 will be my total enterprise value if I go to say 2530. Next you have, so this is total. Then you have operating. Operating will have 2530. From this you will deduct, I think, listed equity and associate companies 120 and 80. So this is 2330. So this is 2330. And then you have core. So in the core you will subtract from the 2330 minus 60 minus 40. So over here maybe 2230. This is your core. Great. Then you look at the EV by EBITDA multiple. This is 2230 divided by 280. So this comes to around, I believe, 7.96. Now your industry is trading at around 9.5. So you are significantly undervalued as compared to the industry. So this is around 8, and interpretation so is lower, and company seems to be undervalued, assuming they have similar business and growth prospects. Uh, so when I look at, let us say, my company, ideally the true value should have been 280 into 9.5, looking at the industry's parameter, that is 2660. But my core value is 2230, and hence there is a valuation gap of around 430 crores. Okay, the last point says enterprise value considers claims of all providers of capital, so it is better. It is less affected by differences in capital structure because it looks at the overall company valuation. It's more of a theory working. Okay, so this takes care of question number 13. Next, you are going into question number 14. Now, there are multiple alternative valuation methods for free cash flow. Like usually when we did free cash flow, the formula for free cash flow to the firm, the normal formula that you would have studied would be based on PAT. So you take PAT plus interest into 1 minus T and plus depreciation and all of those changes. So this is the core formula, I would say. This is PAT plus interest into 1 minus T plus, let us say, depreciation minus increase in working capital minus capex or increase in fixed assets, as a case may be. This will give you free cash flow to the firm. This is a normal formula. Now this working over here can get replaced, so we can say alternatively, so maybe this is for your question number 13, this is for your question number 14. This working can get replaced, so we can say FCFF also equals EBIT into 1 minus T. This will give you the same answer, and we will see that. Plus depreciation, all else remaining constant, minus increase in working capital minus capex. So this will give you the same ultimate answer. Or another method, we have done this as a shortcut as well, is you start with EBITDA. Now when I start with EBITDA, the thing is, in EBITDA, depreciation is also not yet deducted. You do EBITDA into 1 minus T. But in this case, let's say your profits were 100, out of which, let us say, there was some depreciation. Depreciation actually gives you tax savings. Now when I do EBITDA into 1 minus T, ideally the tax savings of depreciation do not come through. Depreciation is operating in nature, it is not financing in nature. Interest is financing in nature, depreciation is operating in nature. So over here we would say that, well, you know what, when I do EBITDA into 1 minus T, and we will have a numerical, we'll review this so that it is very clear. Like if I just take 100, or let's say my EBITDA was 150, my depreciation was 50, my let us say interest was 40, and 60 into 30%, let's say my tax was 18, in which case my PAT would come to, let us say, I don't know, 42. Now assuming there is no working capital change, assuming there is no capex, the first method would say that my PAT, which is for example 42, plus interest, which is 60 into, sorry, 40, into 1 minus t plus depreciation, which is 50. How much will we get? Let's say there is nothing else. Let's say there is nothing over here. So this will be 40 into 0.7 plus 42 plus 50. It will come to around 120. Even over here, if I take EBIT, this is my 100, which is EBIT. 100 into 1 minus t, which is equal to, so this is already before interest, I don't need to add back interest again, into 0.3 plus depreciation of 50. So this is, let's say there's nothing over here, so this is 70 plus 50 also comes to 120. This is also acceptable. Or you take EBIT before depreciation EBITDA, but from this you will then add back depreciation into t, because depreciation gives me tax savings. But when I do EBITDA into 1 minus t, I ignore that. So I'll have to consider this. So this is, let's say, 150 into 1 minus 0.3 plus depreciation is 50 into 0.3. You will get the same answer. Let's see, if you do 150 into 0.7, that is 105, and 50 into 0.3, there you go, you will have exactly 120. This is also another way to calculate your free cash flow to the firm. Now, apart from that, there can also be an FCFE, and from FCFE you can come to the answer, or there can also be CFO. Now, in this, I think the question which is given in the, or the, not the question, the formula which is given in the study material is not as accurate for the CFO. Now, if you have a cash flow from operations, now let us say there's no working capital changes, but if I look at a CFO or your cash flow from operations, you typically start with PAT, which is I think 42 plus tax, so it comes to PBT, which is equal to 18. So PBT comes to, I think, 60. Then I would say that usually it is in India, I mean, they have copy pasted, I think, the US GAAP one, which is wrong, because in India we don't really have the US GAAP one. So in the CFO, typically we'll add back the non-cash items like the depreciation. We'll also add back the non-operating items like interest, for example. So over here, when you add back the depreciation, this comes to 50 of depreciation, and you add back the interest. It is in CFO, you don't do interest into 1 minus t, you add back the interest. And let us say from this you will deduct tax paid. I think if 18 is the tax paid, you will get what? 60 plus 50 plus 40 minus 18. So this is 132, which will be your CFO. Now, if I have to come to the free cash flow to the firm from the CFO, I would say that in the CFO, depreciation has been added back, so I don't need to worry about depreciation. My 18 of tax has been taken, my interest has also been added back, so I don't have to worry about it. However, my tax savings on interest has also been considered. When I take the tax of only 18, interest is financing in nature. Depreciation is not financing in nature, but interest is. And hence, I'll have to subtract interest into 1 minus t to get my desired answer. I don't need to touch the depreciation, because in CFO, depreciation has been already added back. Interest also has already been added back in India. The formula that they have given, in my opinion, is wrong, because they've copy pasted and they've said this is as per US GAAP. Now, most of your sums are not going to be as per US GAAP. You don't even know what is happening in the US GAAP. So if I look at this, ideally my CFO over here is, let's say, 132 minus, if I go to see, my interest is 40 into 30%, that is a tax. So this is 12, and you get exactly the same 120. Okay. So another thing that they give you is the reconciliation between FCFF and FCFE, which we have done, where you start with FCFE. You said that in FCFE you deduct the interest. In FCFF you don't. So you interest into 1 minus t, you will add back. And in FCFE you have adjusted the borrowings. Like if there was a repayment, you have deducted. Here you should not be. So debt repayment you will add back. And let's say if you have taken debt, that must have been added in FCFE. You don't have to add that. So minus debt taken, you deduct. So this is opposite work movement, and you should get your final answer. You don't have FCFE over here, so you may not be able to play around with that. So when I look at, let us say, these alternative formulas for your FCFE, FCFF, etc., over here it is mentioned. So when I look at alternative formulas for FCFF, this is on page 5.11 of your material. So this is based on net income that we discussed. This is based on EBIT. So this is a point that you can possibly highlight. EBIT into 1 minus t. This is interest into 1 minus t. Based on EBITDA. So this is EBITDA plus depreciation into tax rate. Everything else is remaining the same. So there's no further change over here. Based on free cash flow, we said, okay, we'll add back interest into 1 minus t plus the principal repaid minus new debt issued. So this is what you will adjust if it is free cash flow. In my opinion, point E, this is I've taken exactly from the study material, but this is wrong, because if you do, your numbers will not reconcile. CFO plus interest into 1 minus t minus k. No, this is wrong actually. Here they are saying as per US GAAP. Now, why as per US GAAP? So over here, you will say, okay, ideally this is minus interest into T. This is when your answer comes to be correct. The tax effect on interest is kind of reverse because interest is financing in nature. Tax effect on that also should not be considered. But interest has already been, so they are saying clearly if interest has already been adjusted in CFO, it will not be added back again. Okay, fair. But this is as per US GAAP what they have given. So now if I do a particular sum on this on question number 14 with different methods, ABC reported the following information for the year ended 31st March 2015. So you will have net income, EBIT, EBITDA, interest. A lot of these data points are given. Assume there is no change in the non-cash net working capital during the year. Okay, so there's no working capital changes. There is some capex, so you will probably have to take capex, but there's no working capital changes per se. Calculate the free cash flow to the firm using the following methods. The net income method. So if I look at the net income method, I will start with the net income, that is 84 plus interest. Interest over here is 40 into 1 minus t plus the depreciation, if any, well, this is plus 50 and minus capex, this is 90. Now principal repaid, new debt issued, this will definitely not impact the FCFF, and as a result over here if I go to see 40 into 0.7 plus 84 plus 50 minus 90 comes to 72. So this will be, let us say 72, this is FCFF in the first method. Second, they are saying using the EBIT would say that I will start with 160 into 1 minus 0.3, all else remaining constant, plus 50 minus 90, all of this is the same. So this is 160 into 0.7 plus 50 minus 90 comes to 72 again. The third thing is EBITDA, which is 210 again into 1 minus 0.3 plus over here depreciation into T, not into 1 minus T. The tax savings on depreciation which have not been considered should be taken. So this is 210 into 0.7 and plus I think 15. So 210 into 0.7 plus 15 minus 90, and there you go, 72 again. And the last one is using the FCFE method. So FCFE is given to you as 14. To this you will add back interest because FCFE would have been after interest into 1 minus t. So this is plus 40 into 1 minus 0.3. Okay, now FCFE would be after principal repaid. So you will say that now in FCFF that has to be reverse. So you will add back the principal repaid. FCFE would have taken new debt issued and they would have added. Here I will deduct. So if I go to say 40 into 0.7 plus 1414 plus 30 minus 10. No, hold on. I think there is some 14, 40 into 0.7, 28, 30 and 10. I think there is some printing mistake here. Please excuse me. So this is plus 28. 14 plus 28 comes to 42 plus 30 minus 10. I think this should be 24 actually, not 14. This should be 24, my bad. So over here, this is 24. And if you go to this, it will come to around 72. Okay, so I mean, you can even try calculating FCFE from the data which is there, and from that you can go into FCFF as well. So I think this should be based on 24, but I think by and large at a concept level, you should be clear. Okay, so this is question number 14. Now comes the next concept, which is on H model. Now, what do you mean by H model? Well, it is an improvisation, or in a way, an approximation. It is not an exact valuation method. It is an approximation for, let us say, for the dividend discount model. Now, typically in dividend discount model, you have multiple stages. One is the exponential growth phase where the growth is not constant, and one is the stable growth phase where, let us say, the growth rate remains stable. So when I look at the H model, a requirement in the H model is during that high growth phase, the growth declines linearly. That is a necessary requirement. If that is not met, the H model working cannot work. We'll try to put a separate video as well for H model. It is also there as a part of your May 26 exam paper discussion, but we'll review this over here so that you understand the logic behind the working as well. So when we look at, let us say, a particular, uh, let us say, uh, time frame, or let's say the formula is there. I want to understand. I want to you to understand the logic behind this as well, so we can look at the numerical and understand the logic. The formula for H model appears to be very complex. However, it is based on certain basic principles. If you kind of crack that, it should be much more easily understandable. So when we look at the H model, let us say some theory, very basic theory is given in the study material on page number 5.9, where they have said another version is the H model. In the first stage, dividend growth at the high rate for a constant period. Then in the second stage, it declines for some constant period, and then finally grows at a sustainable rate. So this decline has to be linear. This growth, maybe it linear means in the exact same proportion each year. H model is based on the assumption that before the extraordinary growth rate to reach the normal growth, it declines linearly. It will decline linearly for the intermediate period. Now, the formula for H model is given something like this. That is, the price today will be D0 into G. G is the growth rate of the normal stable period upon R minus G, and D0 into H into what on earth is all of this? It's We would want to understand this very logically, very clearly. So I know this formula is there, and how do you use this? Is an approximate way. There's an accurate way to find the intrinsic value, that is the present or future cash flows. But if I look at, let us say, the numerical to understand, remember I'm using this numerical as a base to understand the formula. XYZ has recently paid a dividend of 8 rupees per share. So this is D0. The company expects to grow at a supernormal growth rate of 12% per annum, which will gradually decline linearly over the next 6 years to a long-term sustainable growth rate of 6% per annum. Now, from 12, it is going down to 6 over a 6-year period, which means the fall is 1% each year. It is not compulsory that it has to be 1% each year. It can also be a fall of 2% each year, but it has to be a constant fall. Thereafter, the dividends are likely to grow perpetually at the rate of 6% only. The shareholders' required rate of return is 10%. Calculate the intrinsic value using the H model. Briefly explain why H model is preferred over the two-stage dividend model, because this is theory, but in H model is much more reasonable that growth doesn't suddenly fall from 12 to 16. It usually gradually falls, and hence it's a much more realistic way as compared to the traditional two-stage model. Now, when I look at, let's say the working over here, I want to understand the logic behind the formula. So over here, let us say on one side, I can plot the growth, and on one side, let us say I can plot the years. So over here, let's say year 1, 2, 3, 4, 5, 6, 7, 8, all the way. Let's say this goes up to perpetuity. And even when I look at the growth, let us say over here, I think I could have made a slightly bigger one, but let's say this is 2, 4, 6, 8, 10, 12, 14, 16, and so on. Now, when I look at my current growth in the first year, probably it is around 12%. Now, I'm just not drawing it to scale, it is just for your understanding. And up to the 6th year, it will fall down probably to around 6%. So somewhere over here. So this fall seems to be a gradual fall. Okay. Now, if I want to look at the value after this, the growth rate for all the other years continues to remain the same. Now, what does the H model do? Well, if I want to find the value of a company, I will take the present value of all future cash flows. So over here, this part you can see is growing at the rate of 6% only. So I would say that whatever is the dividend, my total value should be the value generated by this, in a way, open-ended rectangle, and in a way this triangle. Okay, it has been ages since we studied the area of a triangle, but if you can broadly remember, what is the formula for the area of a triangle? Area of a triangle is basically, anyone? Sir, we don't remember what was done yesterday. Half into the base into the height. Okay, so what is the base? The base over here is from 0 to 6 of this triangle. So half into base into height. So this is half into, let's say, the exponential growth period. The triangle is ending at year 6 where the exponential growth happens. So this is half into base into height. Sir, what is the height? Well, this is from 12% to 6%. So maybe this is the 12% minus 6%. Keep a tab on this. So this is the area of the triangle. Okay. Now, if you shave off this triangle and let us say there was no exponential or high growth phase, then what would have been the value? Well, this is the value of this open-ended rectangle. Sir, don't ask us the formula of the rectangle. No, I mean, it's not strictly a rectangle because it is not bounded. It goes on till perpetuity. And how do you find the value of any asset which goes on up till perpetuity? Well, if I look at P0, well, I would say that first, if I look at the value of the let's say green part, I would say that this would be D0. This will grow at 1 plus G of the normal growth phase, which is, let us say, 6% upon KE minus G of the normal growth phase. So this will give you the area for your part 1. This will give you the area for your part 1. Even if this triangle is shaved off, there was no exponentially high growth phase, still I would have this phase, and hence I will get this area over here. Plus I would have, for example, the area under the relatively higher growth phase, where we would say that, okay, this is the area of the rectangle. Now, instead of taking half into base into height, what institute does is, that is why it is called as the H model. It gets a number H. What is H? H is nothing but 1 by 2 into 6. So this is 3. They actually say that H is half of the high growth period. So if the high growth period was 5 years, it would have been also in decimals 2.5. That is fine. So this is basically the area over here will be D0 into, let us say, H, that is half into base into the height, which is the growth of the high growth phase minus the growth under the normal growth phase, upon, again, you want to take this Ke minus G of the normal growth phase. So you want to find, let us say, the value. So if we look at this working, this is nothing but the total of these two values. That's about it. Now, if I go back and if I look at, let us say, the formula, it can possibly make some better sense, where I'm saying D0 into 1 plus G. G is of the normal growth phase. In our case, that is 6%. GC, that is the current growth rate or initial short-term growth rate. So currently it is 12%. It was declined linearly, but it is currently 12%. And H1 is half of the duration of the transition growth period. Now, why would I say half? Well, because over here of the triangle area. So when I look at, let us say, this was 12%, this was half into, in our case, 6 years, which is equal to 3. So this is the logic, I would say, behind the H model. And if I were to apply this, how much will I get? Well, if I look at question number, I think what, 15 that we are doing here, this will be D0. This is 8 into 1.06 upon 10 minus 0.06, plus you will have 8 into 3 into, let's say, 0.12 minus 0.06 upon, let us say, KE, which is 0.10 minus 0.06. So this will come to, again, if I do 8 into 8 into 1.06 upon 0.04. So maybe this is 212, and this is 8 into 3 into 0.06 divided by 0.04. This is maybe 36 approximately. And if I total this, it is around 248. So if I were to review, this is, let us say, 212. I think over here, achha, they are taking D1. Just a second. I think there is some small change over here. This is D0. I think it is D0. So I think there is a small change over here. It is not, it will be based on, just a second. it will be based on 8 into 3 into 0.06, which will come to around 36. And hence, if I total this up, this is around 248. So your intrinsic value, which is around 248, and H model is appropriate because growth rate is declining gradually over time rather than changing abruptly from a high growth phase to a stable growth phase. Hence, it provides a much more realistic valuation as compared to a traditional two-stage dividend discount model. Okay, so this kind of takes care of your question number 15. Next, you have a couple of concepts that we will try on the bond valuation side. Now, in bond valuation, we have done various things like yield to maturity, even forward rates for that matter. But there's also another concept now. It's a kind of a subset of your yield workings, which is something called a spot rate. Now, what does spot rate literally mean? Spot rate just means that it is a rate of a zero coupon bond. Now, when you look at yield to maturity, it in a way is a blended return because there is some coupons, there are some redeem principal values, and considering all of these, what is the rate of return that you want? Typically, we calculate using the IRR technique, that is a yield to maturity. Forward rate refers to the rate which is prevailing in a particular year in the future. Like for example, if the rate of the second year or the rate of the third year or the rate of the fourth year is a forward rate. But generally, what is the spot rate? If today I find a rate which I earn on a 1 year zero coupon bond, that is the spot rate for 1 year. If today I find the rate of return on a per annum basis that I earn on a 2 year zero coupon bond, that is a spot rate for 2 years. If today I find the rate that I earn on a 3 year zero coupon bond investment, that is a spot rate for 3 years. So over here, there's no blending which is happening because of the intermediate coupons that are coming. It is a rate today for a clean 3 year zero coupon bond or a clean 2 year or a 1 year zero coupon bond. This is called as a spot rate. Now you can prepare a yield curve. This is something called as a term structure of interest rate as well. The yield curve, on the yield curve, on one side there will be maturity, on the other side there will be yield. The yield can be plotted as a spot rate, so you can plot spot rates. The yield can be yield to maturity, the yield can be forward rates. It depends. So yield curve is nothing but over the term how are interest rates up, or how are interest rates changing. Like if you go to a bank and you take a 1 year fixed deposit or you take a 5 year fixed deposit today, will that fetch you the same rate of return? No, the 1 year fixed deposit or will have a different rate of interest as compared to a 5 year fixed deposit. And as a result, over here, the difference over here is due to the different terms. So that is why it is called as the term structure of interest rate, also sometimes called as the yield curve. So over here, when we look at, for example, the some theory for this, we would say that, okay, before we discuss the term yield curve, it is important to understand, this is on page 5.20 of your study material, to understand the concept of spot rate. What is spot rate? Well, spot rate over here can be defined as a relationship between the spot rates and their corresponding maturities for a zero coupon bond, which involve no coupon payment. So spot rate as compared to yield to maturity. So the yield to maturity, one can say, of a zero coupon bond is nothing but called as the spot rate. It reflects, let's say, the time value for a single future payment. So there's no coupon or anything coming in the middle. So let's say these are 5 different spot rates which are given to you. And let's say as the term increases, the spot rates are increasing. This, if you were to plot this, you might see an upward sloping curve. As you can see, maybe the yield curve over here is upward sloping. This is called as a normal yield curve. The normal yield curve slopes upward only. However, if the yield curve is sloping downward, that is an inverted yield curve, which possibly shows an impending recession. Like it is likely that the long-term interest rates are lower than the short-term interest rates because people are expecting that in the intermediate term, the central bank will have to reduce the interest rates to increase the demand. And as a result, over here, there's a possibility that you are having, let us say, this to be your normal, to be an inverted yield movement. Or there can be, let us say, different types of yield curve. So this is an upward sloping, which is also called as a normal yield curve. There's a downward sloping, which is also called as an inverted yield curve. Well, flat yield curve obviously means that across a term, whether you're putting a 1 year deposit, 5 year deposit, 10 year deposit, the rate on a per annum basis is the same. and then there's a humped yield curve where the rate is going up and then falling. There can also be a yield curve which is kind of an irregular yield curve. Most of the times you will see the upward sloping yield curve. A downward sloping yield curve can be taken to be a leading indicator of a possible recession that can also be coming. Now, there are certain term structure theories. Now, these are a little complex, but before that, we can do, let's say, a question or two to see the yield curve and its impact. So, let us say we look at question number 16. ABC observes the following annual spot rates. So, you'll have 8.8, 8.4, 8, 7.6, and 7.2. So, basically, these are falling. These are spot rates which are actually falling. A zero coupon bond has a face value of 10,000. You are required to find the current price of a 2-year and a 5-year zero coupon bond with the spot rates. How will I find? Well, for a 2-year bond, the relevant rate is 8.4%. So, value after value today is the present value of the future cash flows. After 2 years, I'll get 10,000. And in today's terms, this is into PV factor at the rate of 8.4% for the second year. This is 1 divided by 1.084, 1 and 2. This is 0.8510. So this is 8,510. For a 5-year bond, this will be 10,000 into 1 divided by 1.072, 1, 2, 3, 4, 5. So maybe into 0.7064 or 7064 will be the price of a 5-year bond. That's about it. So basically this is 8510 approx and this is around 7063 approx. So we know what the spot rate is. Based on the above spot rates, identify the shape of the yield curve. Well, for a 5-year maturity, the rate of a zero coupon bond is lower. So this is a downward sloping, it's an inverted yield curve. It's a downward sloping, that is inverted yield curve. And what does such a yield curve generally indicate about the market's expectation? Well, usually the long-term rates are higher. So that is a normal yield curve. But if they are, like in this case, lower, this shows the market's expectation of a relatively downward recession movement, because in a recession the central bank will have to go down, it will have to reduce the interest rates to bring up the economy. So over here it probably shows an impending recession. A downward sloping yield curve indicates investors expect rates to decline, expects monetary easing by central bank, and is often viewed as an indicator of an impending economic slowdown or a recession. So this is regarding what you call as the term structure, that is the changes in interest rates over the term. However, there are around 3 term structure theories. Now on this, it is difficult to formulate a numerical because it is based on expectations. However, there can be an MCQ or a theory based case which can come. So there are 3 term structure theories. What do you mean by term structure theories? Theories which help you say that what will be the interest rates over the term. Like the first one is an expectations theory, second was a liquidity preference theory, the third one is a preferred habitat or a market segmentation theory. Definitely this can be tested from an MCQ or a let's say theory perspective or a case based perspective as well, rather than a numerical. So when we look at, let us say, the term structure theories, like if I look at the liquidity preference theory first before the expectations theory, what does the liquidity preference theory say? Investors prefer liquidity. Now, if someone tells me to put money for 20 years versus someone tells me to put money for 20 months, I'm okay to put it for 20 months because my liquidity is not getting as much impacted. But if someone is telling me to put money for 20 years, my liquidity is going to be kind of blocked for a very long period, and hence to compensate for that I will demand a higher return. So the liquidity preference theory clearly says that the longer term bonds will have a higher rate of return or yield as compared to the shorter term bonds, and as a result a liquidity preference theory is considered to be, let's say, favoring a normal, that is upward sloping yield curve. So as per this theory, investors are risk averse and they want a premium for taking risk. More the money is blocked, more the uncertainty. Longer term bonds have higher interest rate risk because of the higher maturity, hence longer term interest rates. This theory clearly says longer term interest rates should have a premium for such a risk. Further, people prefer liquidity and they're forced to sacrifice them for a long period like 20 years. They will need a higher compensation. Hence, as per this theory, the normal shape of the yield curve is a positive yield curve. Now, this is the liquidity preference theory. Now, the preferred habitat theory, which says that, well, to have this general umbrella conclusion is usually not correct. Uh, they say that investors in the market have their preferred habitat, that is their preferred range of investment. Like for example, you will have insurance or pension funds which will usually prefer the longer term bonds only. They don't want the shorter term bonds. Their liabilities are going to fall due over a long period, versus a commercial bank who will prefer a relatively medium term, uh, or a money market manager who will prefer a shorter term tenure only. So they say that, to say that only longer term people, if you have to force them to go for longer term, you will have to pay them premium. An insurance company will want a longer term, or a pension fund will want a longer term investment only. So preferred habitat theory says that every habitat, let's say the short term, the medium term, the long term, will have participants, and the rate being higher or lower is a function of demand and supply in that habitat. Like in the long term, if there are a lot of buyers but there are very few sellers, then people will be ready to pay more. uh, I mean, they will be ready to even settle at a different interest rate because they want a longer term exposure. Versus if there are many issuers who want to raise money for the long term, but there are very few buyers, then issuers will have to fight for those buyers, and hence they will have to give a higher interest rate. So you will have to look at the habitat, and they say that if, let us say, you want to move someone out of their preferred habitat, then you have to pay compensation. Not necessarily because it's a longer term liquidity preference says if it's longer term pay compensation. That is not what preferred habitat theory says. They say that if you want to move out of, if you have to move, let's say, and even an insurance fund out of the long term to the medium term, you have to pay them, let us say, a certain premium. So the theory states that different investors may have different preferences for shorter and longer term maturity, and therefore they have their own preferred habitat. Interest rate structure depends on the demand and supply for different maturity periods for different market segments. It is a pure function of demand and supply, in my opinion, the most logical of the theories. In case there's a mismatch between these forces, the players of a particular segment should be compensated at a higher rate to pull them out of their preferred habitat, and that will determine the shape of the yield curve. This theory does not advocate a normal upward downward humped. It says it depends on the demand and supply at every uh, habitat, and hence the shape of the yield curve can be upward, falling, downward, either of these. The expectation theory is a very basic theory. It says that the as per this theory, the long-term interest rates can be used to forecast the short-term interest rates in the future. Like, this is a concept based on which your forward rates, if you remember, are set up. So we'll say that, okay, if I have a long-term rate, based on that, I can predict the short-term rates in the future. Long-term rates are assumed to be unbiased estimate of the short-term interest rates in the future. So if you want to predict forward rates, where you say that, okay, I have the long term rate, and based on that I want to predict the shorter term rate, that is the expectations theory essentially. So over here, when we look at, let us say, maybe a case which will give you certain statements and expect you to identify the term structure which is applicable, that can be a possible question. So a financial analyst explains the shape of the yield curve to three different investors. Scenario 1, the analyst explains that the current long-term interest rates mainly reflect the market's expectation regarding future short-term interest rates. Okay, the investors expect the central bank to reduce the interest rates in the coming years. Well, it is probably a downward sloping curve, but this is maybe an expectations theory, because I'm not really demanding a premium for the longer term bond or anything. I'm just saying that this is, you can predict, let's say, the future short term rates based on, let's say, the long term rates which are available. Second, Mr. A is willing to invest in a 10-year bond only if he receives a higher return than on a 2-year bond, because he's sacrificing liquidity and taking interest rate risk. This is liquidity preference theory, where I would say that ideally, if I want to go into the longer period, I will have to seek more premium or compensation. This will showcase a normal or an upward sloping yield curve. Insurance companies generally prefer longer term bonds, whereas commercial banks prefer shorter term securities. Investors normally remain within their preferred maturity segment unless sufficiently compensated. This is the preferred habitat, also called as market segmentation theory. So first is expectations theory, second is liquidity preference theory, and third is the preferred habitat theory, and they have given you the concept summary for these points as well. Okay, so this kind of helps you in, let us say, building up for your understanding. And next you go into another topic over here, and this is on mergers. So we are done with security analysis, security valuation. In mergers, well, what can be asked or what can be checked on from a theory standpoint can be certain takeover defenses, or maybe certain, let us say, strategies which are uh, uh, either a takeover defense strategy which may be done in a theory, or maybe, so this is a defensive strategy. A takeover defense means, let's say there is an acquirer who is coming to acquire a target. The target wants to defend against that acquisition, a hostile takeover. So they will employ certain strategies. Or the other way around, an acquirer, an offensive strategy who wants to go out and acquire, they can take certain offensive strategies for this purpose. So this is, let us say, an offensive strategy. Other than that, in mergers, there's a lot of theory, like you'll have terms like what are the objectives of merger, synergies. Synergies is 2 plus 2 is equal to 5, for example. The value of acquisition. The value of acquisition really is the difference between the post-merger position and the total of the pre-merger position. Like if I want to do it on a profitable, I'll say profit post-merger minus the combined profits of the entity earlier. Or let's say the market value post-merger minus the total of market values pre the merger. That will give you, let us say, the benefits or value of the acquisition. Some theory points that we can possibly review over here, let's say on the mergers section, would be, we'll just, like over here they have looked at the gains from mergers or synergies, like if there's value of A which is at 100, value of B which is 50, and A and B combined is at 175, then 25 I believe will be the value which is the total benefit due to the merger. And if the premium is paid as 10 rupees, then the net gain or synergy for me as an acquirer, I'll say 25 is the overall value accretion, and I'm paying 10 rupees as a premium, so maybe the remaining 15 remains with me. Okay, other than that, these let us say takeover defense tactics. First is the takeover strategies. This will be applied by the acquirer, whereas this are applied by the target. Defense strategies, whereas takeover strategies are applied by the acquirer. Now takeover strategies can be something like a street sweep. Now these are very fancy terms, like people like to go in M&A, a lot of fancy terms over here. Street sweep. So this is over here technique where the acquirer goes to the street, that is, let's say the stock market, and takes up as many, accumulates as much as possible from the stock market only before they go and make, let's say, an open offer or go to the board. So this is also sometimes called as a creeping acquisition, that you will go to the street and you will sweep out whatever is the stock which is available from, let's say, these minority small sellers. So this refers to a technique where acquiring company accumulates a large number of shares in a target before making an open offer. So over here, this is like a creeping acquisition or a street sweep. A bear hug would be a situation where acquirer threatens the target company to make an open offer and the board agrees to a settlement via, so when we go, like for example, Twitter's management was not ready to sell Twitter to Elon Musk. However, he said, well, you know what, I'll go to the shareholders, offer them a 30% premium, and you know what, will be kicked out of the company. He actually did that. He offered a 25 or 28% premium. The shareholders in the open offer said, well, whatever your differences are with the management, forget it. We are getting 25% more. We are ready to sell the shares. And as a result, the control of Twitter shifted. So maybe Elon Musk gave a bear hug to Twitter. Strategic alliance over here would be disarming the acquirer, inverse disarming, by offering a partnership rather than a buyout. So over here, the acquirer should assert control from within and take over the target company. So I'm giving a strategic alliance, and using the alliance, maybe I will then go ahead with the acquisition. And brand power would mean I would enter into alliance with other powerful brands to displace the target's brands, and this will weaken the company. So there are offensive strategies where you will either do a street sweep, go to the market and take as much as stock as possible, a creeping acquisition, bear hug, where I will threaten the target to go directly to the shareholders and kind of displace the management. Third is strategic alliance or a brand power. Strategic alliance, where you will have a partnership rather than a buyout, versus a brand power where you partner with other companies to weaken the company. So these are the four offensive strategies. In terms of defensive strategies, there's divestiture, which means if someone, so this is defensive. Now this is employed by the target. So if someone comes to acquire me and I know that they are interested in this particular segment, I will divest it into a separate company and maybe give ownership to someone else. So when a target company divests or spins off some of its businesses into a separate company, reducing the attractiveness. So this is like a divestiture. A similar name for that would be like a crown jewel. If I know that a company is acquiring me because it wants my, let's say, patent or my oil field or something, I will divest it, sell it, or in sometimes destroy it. Like this happened during the Iran, not this war, the Iran-Iraq war many years back, where they burned their oil fields. They say, you are coming to us because of the oil, let's say we'll burn these oil fields. So this is destroying your crown jewels. Poison pill and a poison put. Poison pill is I am giving convertible debentures or I'm giving instruments to my existing shareholders with the condition that if a takeover happens, these will be converted at a very favorable price, and thereby the acquirer now, if he's taking over, will have to kind of pay for the existing shares plus, because if he's acquiring, and as per the terms, there'll be a lot of other debentures which will convert into equity shares. This will increase the cost of acquisition to the acquirers, so like a poison. So used by target to make itself unattractive. Uh, the target company may issue substantial amount of convertible debentures to existing shareholders to be converted at a future date when it faces a takeover threat. So this is conditional on facing a takeover threat. So this makes it a little unattractive for the acquirer to go ahead and do the acquisition. A poison put, on the other hand, would involve target company issuing bonds that encourage the holder to cash in. So to redeem, put is a right to redeem. So whenever some acquisition is happening, there'll be a clause that these debenture holders will have to be paid. Now, for the acquirer who is doing the acquisition, he has to pay off these debentures. He has to arrange so much cash to pay off these debentures. So it's like a poison put, which will happen at a higher price. Green mail over here is if I see, like in a street sweep, I see that you have accumulated a 20% stake of my company at 100 rupees, for example. I offer you to buy that 20% from you at a higher price, and so that you are shooed away. Maybe I'll pay you 120, 130, 140. You say, okay, you have acquired 20%. I will buy that 20% that you have acquired at a higher price, make the profit and run away from here. So green mail is an incentive offered by the management to the potential bidder for not pursuing the takeover. The management of the target company offers a higher price for its shares than the market price. So whatever price shares you have, I'm ready to offer a higher price so that I acquire and you run away. White knight or a white squire. Now, white knight is, this was applied a lot in earlier Indian companies going out to acquire European companies. Whether you agree or not, a lot of these European people would have, let's say, some inferiority that how can we be governed by, let's say, an Indian company or an African company. So they would say that, okay, might as well, if I'm going to be sold, like one of the richest Indians is Lakshmi Mittal of Mittal Steel, and he faced this when he was trying to acquire Arcelor, one of the biggest French and the oldest French companies. So they got a white knight, I think Severstal or someone from Russia. They said, okay, we are okay selling to you rather than this company. So this is like a white knight. I will say that I want to sell. I know that someone is going to acquire me, but I might as well sell off to a company which is, let us say, which I know, rather than the company who is trying to acquire offers to be acquired by a friendly company to escape from, let's say, a hostile takeover. This happened in case of Lakshmi Mittal and Arcelor Steel. White squire would mean that the acquirer is not really the person. Like white knight, you bring in someone, even white squire, you bring in someone. However, that person that you bring in is not really very interested in the company. But let us say the management says that, well, you know what, you just pumping the money like a venture capital or a private equity fund, and we will run the show. It's like a management buyout, for example. So this is essentially the same as white knight and involves selling out shares to a company that is not really interested in the takeover. Consequently, the management of the target company retains control over this company as well. Then there are golden parachutes. And golden parachutes was there even in the Elon Musk acquisition, where the existing management like Parag Agarwal, who was there, if you have to oust him, you have to pay a huge compensation like $500 million or so. But for Elon Musk, that is loose change, for example. So over here, maybe you have a huge exit clause for the existing management, where the acquirer who acquires might have to pay a huge amount to the outgoing manager. So that is a golden parachute, offers hefty compensation to the managers if they get ousted due to a takeover. So this is a golden parachute. And Pac-Man defense is like reverse Uno. You are coming to acquire me. You know what? I will go back and I will acquire you. So this is like a Pac-Man. This was a game which was there earlier. I don't know, you might have played this or not. It was the game in the 1990s or 80s, where the target company makes a counter bid for the acquiring company. This would force an acquirer to possibly defend himself and may call for a proposal, call of the proposal of the takeover. This is, let us say, one of the strategies. So over here, there are a few questions. Maybe most of these will be more of a MCQ or a case study or a theory question rather than a numerical one. So let us review this, and this can kind of put to end, let's say, the first part over here. So around, we would say 60 odd questions that are there. We'll break this up into 3 sessions of around 20 questions each approximately, so that we cover the entire part. So question number 18, XYZ is a listed pharma company. The multinational competitor Global Pharma announces a hostile takeover bid. To defend itself, the board considers the following proposals. These proposals are independent: sell its highly profitable oncology division to a separate subsidiary before the takeover is completed. I would say that this can be called as a divestiture, or this can even be called as the crown jewel defense. Okay. Issue convertible debentures to existing shareholders, which will convert into equity if the takeover proceeds. This is, I would say, a poison pill. Poison put would mean that debentures will be encashed. Invite a friendly Indian pharmaceutical company to acquire XYZ instead of a global pharma. This is a white knight. Squire would be a situation where you bring in, let's say, a fund or someone who's not really interested in this company. The management will run the show, but I want, let us say, some other party offer substantial compensation to the senior management if they lose their positions. This is a golden parachute. And make a counter offer to acquire Global Pharma itself. This is called as a Pac-Man defense. Okay, so crown jewel or divestiture, poison pill, white knight, golden parachute, and Pac-Man defense. Okay, then you have question 19. Nova Technologies wants to acquire Sigma. During the acquisition process, the following events take place. Nova quietly purchases shares of Sigma from the stock market over several weeks before announcing any offer. This is called a street sweep. Okay, before launching a formal bid, Nova informs Sigma's board that unless negotiations begin immediately, it will directly approach the shareholders through a public offer. This is called as a bear hug. Sigma refuses to sell the company. However, it offers Nova a long-term strategic partnership for jointly manufacturing electrical vehicles. This is called as the strategic alliance. This is not brand power. Brand power means the acquirer, that is Nova, goes out to other let's say companies, forms alliances to weaken Sigma's position in the market. So over here, let's say street sweep, bear hug, strategic alliance. These are offensive strategies. And question 20, these are independent situations. Identify the most appropriate strategy or defensive technique, as a case may be. A target company issues bonds containing a clause that the bondholders will demand immediate redemption at a premium. This is poison put. Put is like a redemption. So this is giving you an immediate redemption. So this is a poison put. The promoters of the target company buy back the hostile bidder's stake at a substantial premium to persuade them to abandon. See, this is not Pac-Man. In a Pac-Man, you counter bid to acquire the selling company. Let's say the target tries to counter bid and acquire the acquirer. In a Pac-Man, over here, I'm not acquiring you, but the shares that you took, let's say using maybe a street sweep or something, 10 or 15% stake that you might have, I will take that from you at a premium so that you kind of run out. So over this is like a green mail. A listed parent wishes to unlock the value of its fast growing subsidiary while retaining management control. It proposes to sell only a minority stake to the public through an IPO. Well, this is a carve out. I mean, you might have done some theory. We'll review that if required. There is this carve out, divestiture, spin off. So this is a carve out where you are removing that into a separate company, that is called as a carve out to unlock value. An acquirer deliberately enters into alliances with globally recognized brands so that the target company's brands lose market share and eventually the acquisition becomes cheaper. This is like brand power, like using your muscle to kind of squeeze out this target. A financially strong private company enters into a merges itself into a listed but a weaker company, resulting in the shareholders of the stronger company obtaining control over the listed. So it's like an unlisted company acquiring a listed company. This is sometimes called as a reverse merger. In a reverse merger, a smaller company acquires a larger company, or an unlisted company acquires a listed company, or a loss-making company acquires a profitable company. This is typically considered to be the case of a reverse merger. So this kind of largely takes care of the section of mergers as well. And in a way, the first part over here, uh, in the subsequent parts we will also discuss the other areas. So I hope we have kind of tried to cover this comprehensively rather than rushing through. I hope this has been helpful for you, and I'll see you soon with more such videos and content. If you like this video, please do press the like button, share it with your friends, mention it in your comments, that those words of encouragement also mean a lot for us. And I'll wish you again all the very best. Keep smiling, keep pushing your limits, keep working hard, and I'm sure your CA prefix is very nearby. I'll see you soon. Till then, bye bye, take care, and lots of love.